So liquidity ratios, we want to know about working capital, current ratio, and the acid test ratio. So working capital represents current assets financed from long-term capital sources. So what we're looking for is how much money do we have today to play with? That's the fun way to think of it. How much money do we have today to spend on in current investments? And so all we're going to do, and this is just memorizing the formula, is 65,000 current assets minus current liabilities is going to equal our working capital. That's it. That's our working capital assessment. And so where this might be confusing for you is on your exams or in real life, when you're doing this assessment, is these might not be given. Current assets and current liabilities might not be given. And so you would have to know that cash, accounts receivable are all parts of current assets, inventory, and then accounts payable and current notes or current portions of notes or short-term notes are part of current liabilities to recalculate these amounts. The more working capital we have suggests strong liquidity, right? Meaning we can afford to pay off our debt, our short-term debt. We can be in business for the next year. We're not going to have a problem. We have some cash. The way that we compare this to other companies is through the current ratio. And so this working capital is just to determine the dollars of working capital, the money we have to play with in the year in excess of what we expect to owe. So the current ratio is how we compare it to other companies. So same example, but instead of us subtracting it, we'll divide. So we take the current assets over the current liabilities and we'll determine how much, what is our ratio. So memorize this. What is our ratio of current assets to current liabilities? Anything over one or over means that we're liquid. Anything under one means we're illiquid and we need to find some cash quickly because we're not able to satisfy our current liabilities and we'll be in trouble and have risk of bankruptcy. The higher this is, the better, generally, because we're able to determine we're going to be able to be more liquid. And so then we can compare the current ratio to our competitors to see how well we're doing. Remember, a lot of companies try to do well with their cash management. So the higher it is, the better it is for liquidity, but maybe not for profitability. Because if we have a lot of current assets, like a lot of cash that we aren't using to expand our business, it could be troublesome. It could mean that we're not using our capital wisely as investments. So that's why companies aren't always sitting on a lot of cash. They're reinvesting in their business or external investments. So there's a risk here, right? Current assets include a few pieces that are really difficult to say that we'll collect cash on. And so a lot of investors don't like including those pieces in liquidity analysis, especially bankers, right? So they use something called an acid test ratio instead. The main piece here is we're excluding inventory from this test. So because a lot of companies say, well, if let's say the coronavirus is a great example right now where people just don't want to go buy your inventory. It doesn't matter that you have $1 million in inventory. If no one's going to buy it and you can't sell it, are you going to be able to convert it into cash? And so, and financial analysts came up with the acid test ratio, which is anything that can be convertible into cash relatively quickly, very, very quickly, and is almost certain, then we're going to use that to determine our liquidity. And so what we're going to use for the acid test ratio is just cash, short-term investments, and current receivables. So these are pieces that we expect to turn into cash with no problem at all. And then we'll divide it by our current liabilities. So this is different where we're excluding inventories. And also you notice we're excluding prepaid expenses, right? Because that would be difficult to get refunds on. If you prepaid your insurance for a year and you needed the money back, likely the insurance company is going to give you a hard time. And so really the point of the acid test is it's a more stringent requirement in order to determine if the company's liquid. So I expect you to memorize the working capital calculation, the current ratio calculation, and the acid test. All different ways. Working capital, again, is a way to see how much cash we have left over to play with in excess of our current liabilities. Current ratio is so we can compare our current assets and current liabilities. Anything over 1 is good. Anything under 1 is bad, means risk of bankruptcy. An acid test is a more stringent requirement in order to make sure that we can meet to meet these requirements, meet the short-term liabilities. And so here's a perfect example where I could just ask you to calculate each one of the ratios. So I could say, for this, please calculate your working capital, please calculate the current ratio, or please calculate the acid test. And so to calculate the current ratio here for 2017, we're taking the 31,800 plus 89,500 plus 11,500 plus 10,700. But we're going to exclude the plant assets, because plant assets are long-term, right? And then we'll divide it by our current liabilities. What are our current liabilities here? Just the accounts payable. And that gets us our 1.88. All of these other ones are long-term, so they have to deal with solvency, not liquidity. We have a question. So this current receivable and acid test ratio includes the current amount of notes receivable. Yeah, current receivable, yes, it would include the current amount of notes receivable as well. Good question. The answer there is yes. Anything we're expecting to receive within the year, that's almost certain to be, almost guaranteed to be cash. So how would this compare to the acid test ratio? Acid test, we'd exclude the inventory and prepaid expenses. And so you can see here, the company might be liquid in 2017 from a current ratio, but then illiquid from an acid test ratio. Where let's say their merchandise inventory and prepaid expenses couldn't become cash. Let's say they had trouble selling it, or it was out of date, then this company would be in trouble, which is why we need both of these ratios to compare. And that acid test ratio, we just take the 31,800 plus the 89,500 and divide it by the 129,900. The other risk here is too, we're seeing the ratios go down, right? So that was vertical analysis or ratio analysis. Then we can look horizontal analysis that these ratios are going down. So the company is having some cash problems, some liquidity problems as their money gets tighter. And that's something we'd want to investigate. As a company, you're required to tell investors if there's a likelihood that you might go bankrupt in the next year. And that's called a going concern assessment. So if you ever see that language on a financial statement that the company is worried about its going concern considerations, right? Going concern means that we think the company will last forever. If we're saying that the company is concerned about their going concern, then it means that they might not last the year. And so you'll probably see a lot of that on financial statements coming out over the next year. So those three pieces, right? Know your working capital, your acid test, and your quick ratio. I'm not going to be worried about day sales, but I'm going to talk about it today just so you're all aware. I want you to know about inventory too. And so the question is, how quickly do we sell our inventory? So the way we can measure that is just dividing our cost of goods sold by our average inventory, because that tells us how often we sold our inventory in a period. Very useful, easy way to determine it. So the hard thing here is cost of goods sold will always be given to you, but just determining our average inventory, we'll just take our beginning inventory and our ending inventory and divide it by 2. In this example, they're just taking the 10,000 plus 12,000 divided by 2, and then you take your 140,000 cost of goods sold divided by that amount, which was 11,000, to get your 12.73 times, which means that they sold their inventory that they had about 12.73 times. It tells us how quickly the turnover is. That could be useful if we're comparing Walmart to Target and see, well, the higher this is, it means that the company's managing its inventory very well. It's not holding on to a lot of inventory, it's turning it over very quickly. If we see low inventory turnover, we'd expect that with bigger equipment, like cars might have a longer turnover time. And we can compare companies. Ones who have higher turnover means that they're able to sell the goods they have more quickly, which generally means that they're managing their inventory stronger. So just better inventory management. These last pieces are day sales uncollected, or day sales collected, or days in ending inventory. This just helps us know how long it takes us to collect our receivables. So this is a useful metric to see if we need to improve on the collection side of our business. And so what we do here is we take our accounts receivable net divided by our net sales and multiplied by the number of days in a year. So let's say we had 20,000 accounts receivable at the end of the year. We had $494,000 in sales, right? Multiply that by 365 days, and we get about 14.8 days. It means that it takes about 14, 15 days for us to collect on our accounts receivable, which is generally good. Anything over under a month is generally considered good days sales uncollected. Anything over a month is generally seen as needing improvement. We can do the same thing with days sales and ending inventory as well. Just take your ending inventory divided by cost of goods sold, multiply by 365, and that tells us how long our inventory is sitting on the shelves. Remember, it's expensive to keep inventory on the shelves. We have to pay for the warehousing costs, we have to pay for the storefront costs, and so we want to shrink this as much as we can. All of these are liquidity ratios. Everything that's not, everything that's highlighted here, like inventory turnover, your quick ratio, your acid test ratio, your working capital, I expect you to memorize those formulas for your exam. But understand, these are all different ways we can see how quickly the business can obtain cash.